Welcome to the Commercial Real Estate Academy podcast, the podcast dedicated to simplifying the commercial real estate industry for the masses. Each week, we sit down with industry experts to dissect the many facets of commercial real estate and extract valuable lessons you can apply to your business. Whether you're a new or seasoned business owner or investor, the Commercial Real Estate Academy podcast will be your go-to resource for all your commercial real estate needs. Now, here are your hosts, Raphael Collazo and Jeff Walston.
Welcome to the Commercial Real Estate Academy podcast. I'm your host, Raphael Collazo, here with my co-host, Jeff Walston. How's it going, my friend?
It's going great today. Been very busy, but I'm excited to start this and let everyone listen to this podcast.
Awesome. Yeah, no, it is a Friday for those of you guys, at least as we're recording this, it is a Friday. So I know both of us are looking forward to a fun weekend with our families, and I'm sure you guys are as well. But today we actually had a phenomenal guest, and I don't use it lightly. We really had a phenomenal conversation with Kris Bennett, who's this self-storage managing partner at passiveinvesting.com. The gentleman is just an impressive individual. Really dove into the concept of self-storage, which is, I believe we haven't really talked about it too much on this podcast as of yet, but it really is a phenomenal investment vehicle. And I was glad to learn a lot more about that asset during this call. And so what we really delved into was analyzing self-storage opportunities. So we kind of explained what to look for when you're looking for those types of investments. We even talked about his first self-storage deal and some of the hurdles he overcame in order to get it under contract and, make it perform the way they had projected. We also touched on the opportunity of doing ground up construction for self-storage and determining whether or not there's actually a market for the self-storage that you're developing. And then learning a little bit more about how to leverage social media in order to build your commercial real estate presence. This is kind of a running theme we've had throughout various different podcast episodes, because in a new age with social media being such an important part of business, it's crucial to be able to build a brand. And I know that they've done a phenomenal job, and we kind of picked his brain on the different things that he's done in order to really build his brand and grow the business over time. So really think you guys are going to really enjoy this episode. Jeff, do you have anything else you'd like to add to it?
Just from a general contracting aspect and the construction side of things I didn't know about self-storage to consider when you invest and even develop them. So I can't wait for you guys to hear this episode.
Yeah, and at the end we do dive into some pretty intense topics, which was fun. It was really engaging. And again, like I said, Kris is an awesome individual. And without further ado, let's go ahead and dive right into this episode.
Hey, Kris, welcome to the interview. We're really excited to host you on this podcast today. I know you're going to be able to provide a ton of great insights to the audience.
Yeah, happy to be here. Thank you.
So what we usually do with our podcast interviews is we like to learn a little bit more about the person that we're interviewing. So can you kind of tell us a little bit about yourself and your background?
Yeah, sure. So on the real estate side, I've been involved in the business in some form or another for, 13 years or so. I got my license in 2007, real estate license in 2007 in North Carolina. Obviously, our real estate classes were full, business was booming. And then 2008, all that came to a standstill. I was working actually in the foreclosure industry, so I was a little bit fortunate there. However you want to look at that, fortunate or unfortunate, but I was working in the foreclosure industry. So I worked with investors who had cash to buy rental properties, single family homes. So think of a single family home of like $50,000, $80,000, most of the time they were under $150,000 here in the Charlotte market. That is unheard of. That is incomprehensible at this point in time in the market. So I remember selling houses in downtown Concord, which is just a little suburb of Charlotte, and then other homes in Charlotte elsewhere that would be double or triple their value at this point in time. Basically doing no renovations, it would just be worth a lot more. So anyway, that's kind of where I got my start, and then got kind of sick of it. Making a long story short here, ended up going to community college and then transferring to UNC Chapel Hill, over in Chapel Hill. And that's where I got my first taste of multifamily and kind of private equity and syndication. I actually worked for a firm there in Chapel Hill called Eller Capital. Daniel Eller brought me on, and he said, "Hey, can you work and do this and underwrite and all this kind of stuff?" And I said, "Sure." I had no idea what I was doing. So he was gracious enough to show me and kind of teach me. Ended up working for him for 2 summers in a row. And then they have a real estate fund at the school, at the business school at Chapel Hill. Made it to the fund. You have to kind of interview and go through a process. made it to the fund, and then obviously my world was expanded even more. Back to the Eller Capital thing, that was the first time I realized what he was doing. He was raising capital from people to go out and buy these multifamily apartment complexes, 150 units, 200 units, or whatever. Now, people who listen to podcasts, the information is out there. If you go back in time 5-6 years, this stuff, there was maybe a handful of podcasts, right? At that time, I don't even know. I didn't even listen to podcasts then. So there were maybe a handful talking about this kind of stuff. So it wasn't like widely known information, or as widely known as it is now. So anyway, that's where I realized, oh my gosh, he's raising capital, getting money from investors to go buy these things. And I get it now, kind of the light bulb went on. So forget single family homes. This is what I want to do here, So anyway, fast forward, worked for a firm in Raleigh after graduating. We were doing multifamily acquisitions. Make a long story short, we pivoted to self-storage. And that's where I got my start, closed a number of deals, we raised a little fund on crowdstreet.com, ended up moving back to Charlotte, where we were originally with my wife. And that's where I'm at now. And then linked up with passive investing earlier this year. It's 2021, so around January 2021. And then tasked with looking for storage deals for our portfolio. We just closed one March 1st as well. So
congrats on that. And that's a unique background, really, because obviously, and I've heard a lot of our guests have had that similar transition point where they started in the residential space and they kind of dived into the commercial space, and it just kind of fit their skill set a little bit better and their interest level a little bit different. And I think, like you were mentioning, back in 2014, 2013, the concept of syndication wasn't as widely prevalent as it is today. And so you being able to capitalize, or at least get your foot in the door early on in that model, probably has benefited you immensely over the last, I would say, 7 or so years.
Oh yeah. It's you kind of, your eyes are open. Like, all I knew before that, anybody that I ever knew, all that we all knew was real estate, like single family home investing, right? Buy a home, fix it up, rent it out, refinance, go do it again, and again and again, and get 10 units and then, or 10 homes, and you're, doing well or whatever. So that was the idea. And I didn't realize, oh my gosh, you could buy 50 units at one time. So why the heck would you go buy a bunch of single family homes? Because the effort and due diligence and the cost, obviously the cost isn't the same, but the time investment is practically the same. So anyway, and not to knock anybody doing single family homes, I think you can become very wealthy doing that and successful. There's nothing wrong with it. Just for me, it's not what I wanted to do after I had seen the opportunity of syndication.
Sure. It was just where your interest lies.
Yeah, that's it.
Because I 100% agree. There's real estate is for everyone, in the sense that you can start off in the single family space. You can continue to do that if you'd like, or there's other opportunities, whether that's in, multifamily, self-storage, industrial properties. I know investors that are doing extremely well in that space. And even in the office market and retail market, there's ways that you can build generational wealth through those different mediums. So that's
absolutely.
Great advice.
Yep. Absolutely.
So in all the sectors of commercial real estate, why did you choose self-storage to really?
Yeah, when I worked for the company in Raleigh, just to kind of back up for a second, we were looking for multifamily. I was their technical director of acquisitions, which is just a fancy title for bird dog. You're going out there and looking for deals, right? So you're talking to owners and brokers, right? We have all these fancy titles. Really just means, hey, go knock on doors, make phone calls, and talk to people and find a deal. But anyway, so that's what I was doing. And so I underwrote, a ton of multifamily deals, nothing wrong with that. But I realized, oh my gosh, we can't make the numbers work at the market where it was at that time. We were aiming for a certain threshold as far as cash on cash return, et cetera, and the way we were structuring the deals. And it just didn't meet the market at the time. So make a long story short, we would meet with brokers. HFF existed at the time. They were since bought out by, I think, JLL. But we met with a couple of guys over in Raleigh from HFF, and they can raise debt and equity, for deals, et cetera. So we're telling them what we're doing. They said, look, guys, what you're doing in multifamily is not exciting. Everybody else does that. We're not going to raise any capital for you. We're not going to be able to. We're glad to go and try to do it, but it's everybody else is doing the same thing. Whenever we talked about storage, though, they were like, oh my gosh, this is amazing. If you ever find a deal, let us know. We'll invest in the deal. They were like, oh my gosh, storage. So that's what we did. We said, okay, let's go ahead and raise a small fund, put it on CrowdStreet, and we'll go out and buy, 5 to 10 deals in North and South Carolina, and kind of in the Southeast, but we stuck with North and South Carolina for the most part, and, find success that way. So I said, okay, I had no idea. I didn't know jack squat about storage. And so I had to teach myself. And I picked up what's called a self-storage almanac. That's put out by Minico, I think, publishing. It's the only self-storage is the only asset class I know of that has the entire industry in one book that comes out every year, almost like a catalog. So like you could find out everything you ever wanted to know by buying that book and reading it. But anyway, so that's what I did. Articles and bought the book and tried to figure it all out. Looked at a couple of deals, underwrote them, closed on the first one in Charlotte. And I realized, okay, there are like the majority of apartment complexes are owned by sophisticated investors, large private equity groups, et cetera, right? The opposite is true in self-storage. Only 25% are owned by the REITs, the publicly traded REITs, and then sophisticated operators, et cetera. The rest are owned by mom and pops that own maybe one or two facilities, and like that's it. And so the ones we were closing that I was talking to fit that mold. They were in their 60s and 70s. They were looking to retire. One of them actually lived at the beach, and they came in every 2 weeks to check on the facility while they had a part-time person working there for like $10 an hour. So they did nothing online, no marketing, nothing like that. All of her records were on paper. When we were set to close, we went under contract and we were working towards closing. So I was doing some due diligence. They had a computer in the office, and she's like, well, I just bought this like 6 months ago, so I don't need it anymore. It's just like, okay, she pulled out all her general ledger, her ledger cards. They were all on paper in a fireproof filing cabinet. So there's just opportunity in the space. And I realized, with the financing and the opportunity to buy from mom and pops, et cetera, that this is like a great opportunity versus multifamily for where I was at the time. And so that's why I just fell in love. And like, you know what, you can get on a 10 by 10 unit that's 100 square feet, you can get maybe $1. Let's say it's $1 in rent, right? On a multifamily property, if you have 1,000 square feet, you rent it for $1,000 a month, you're still the same square footage, $1 per foot in rent, right? In storage, you can have other financing options with the SBA, et cetera. You can buy more units with less capital. So if you're a private investor, or not even an investor, somebody who just wants to retire, and go live at the beach or whatever, when you're 60 or 70, you can put together a little portfolio of 10, 15 properties, maybe 300 units, 200 units a piece for a lot less capital than you could in multifamily. So that's where I just saw the opportunity. And that's what made me pivot and switch and kind of stick with what I've been doing.
Oh, for sure. And like you were saying, I mean, in the operation expenses for self-storage are a lot less than what you would see in a multifamily setting. And for the most part, it's pretty recession resistant, meaning that when the economy is doing well, people buy more stuff. And a lot of times they have to put the storage in a situation where, the economy is doing poorly, people downsize and they have to utilize self-storage for, storing materials that they've acquired over the periods of good times. So
absolutely.
Yeah, I 100% agree that I think self-storage is a great investment opportunity. If you find those mom and pop operators, I actually had a client that I was working with looking to acquire a self-storage facility, a smaller one. And the same thing applied. They had everything on paper, and there were even people who used to pay with cash, and they would just put an envelope underneath the door, and the guy would come in, pick it up, and it was just like, what is going on? But that's the nature of the beast. So
yeah, the one we just closed in March, the guy still comes by once every 6 months and puts the cash envelope under the door of the previous owner. That owner owned the facility 2 owners ago. He's the guy who originally built the place, and he can't catch him to say, hey, don't give me the money anymore. So he just puts it in our mailbox now he just put it in there last month. So it's a funny situation, but he's the only one. We keep trying to get to him, but he never answers the phone. We're trying to say, hey, you need to stop paying cash because we don't want to take any cash anymore. But you're right. Like there are people that still operate that way on a daily basis. So yeah, tremendous opportunity.
Definitely. So you mentioned, transitioning from multifamily into self-storage. I was wondering if you could walk us through the first deal you did, and then kind of explain some of the lessons you learned from that experience, because I'm sure diving into this particular project, I mean, there's definitely some things that you had to learn throughout the process.
Oh yeah. Yeah. One would be obviously the underwriting and kind of wrapping your head around how that looks, right, for a storage deal, and trying to go back to that very first one. I remember it as far as location and everything. It's right here in Charlotte, over in Belmont, North Carolina. And the story behind it was the husband and wife built the facility from the ground up years ago, I think in the late 90s or something like that. I can't remember now, but anyway, long time ago. And early 90s, I meant to say. And her husband ran it, but he passed away. So he was doing the management day to day. He passed away, unfortunately, and we came along about a year later and she was trying to sell it. I actually found it on LoopNet. Because I knew the area was from Charlotte, I realized, hey, this is an interesting deal and an interesting location. The picture on LoopNet actually showed the roof like missing on part of the buildings. And I was like, what's wrong with this deal? So I asked the broker and he said, oh, that must be an old photo from Google Maps because there's no issues. They had the roof repaired. And so that must be a photo from when it was getting repaired. So, oh, okay. So then we get to the facility, we get all the financials. It's a mess because she hasn't run it. She did run it when they first built it, and then she stepped away for years. So she had no idea what was going on. When we got to the facility, it turned out there was about 40 units that she had no idea whose stuff was in there. She didn't know who the tenants were, and nobody had paid on those 40 units in a very long time. Couldn't track them down whatsoever. By the time we closed, I'm going kind of fast here, but just to get to the point here, by the time we closed, she had trashed out, I think it was like 10. So there's like 30 units left still that we had no idea who was renting, no records whatsoever. So we ended up just donating stuff to, you could access the units too. So there was no locks on some of them. So we ended up just donating the stuff to Habitat for Humanity. And then re-rented those units. And within 60 days, we went from like 70, I forgot what it was. Let's call it mid 70s occupancy up to nearly 90% physical occupancy. So yeah, it was tremendous. And that was with barely any marketing. That's just in 60 days. We repainted the facility, did a few other things to it to make it look a lot nicer, renovated the office, etc. But getting my head around like what were the lessons learned? One was, again, that's a mom and pop opportunity, right? Tremendous upside in that deal, obviously tremendous demand in the market. Back then, I didn't really know the data sets to use and like what is important when looking for a deal. We just drove the market and drove around that facility and kind of felt good about it for the most part. And we ended up being correct, right? Now that market is booming where this facility is located. It's booming. There's new homes going in all over the place. Like it's a great market. I think they made $1 million difference. We bought it for 1.6 or 3. I can't remember. And it sold for let's call it 2.5. I don't remember exactly, but 2.5 last year to a local buyer. So yeah, tremendous upside in that deal. We bought that in 2000, I think it was 2017. So call it 4 years later, sold the property. But the underwriting, understanding like, okay, how does this operate versus multifamily? We ran them with nobody on site, unattended, so like that's a different management style and way of doing things. It didn't really support a manager when it's that small. It doesn't make sense to have someone on site. This was about 22,000 square feet and had a bunch of parking also. So when it's that small, it's hard to actually support a manager full-time on site. So there's a couple things to work through on understanding the financials and how to make sense of the expenses and all the brain damage that went into figuring it out. Who actually is renting at this place? Do you have leases? Like, are these people living and breathing? Like what is the actual income of the property? Because she didn't have good records whatsoever. So there's pros and cons to everything, right? Trade-offs. So in this case, when you buy from a mom and pop, that's part of the trade-off. You have a higher risk in trying to understand the cash flow of the facility. Oftentimes when they're taking cash, like we talked about earlier, they actually don't deposit all that cash. So when we get the tax return, there's, half of what the income actually is, that kind of stuff. One lady, she literally said to me in the office, I got her or bank statements, and she's like, now the people who pay cash, that doesn't always make it to the bank. Sometimes it goes in my pocket. So that's what she like literally told me. And I was laughing there. I said, I don't care like what you do with it. I just want to make sure that people are actually paying. So there's other leases in place. So some of that like difficulty of understanding the cash flow, the expenses, and the opportunity because we didn't understand the right data to look at. So obviously we made an educated guess and it worked out really, really well. But going forward, we learned from that experience and have since, I think, gotten better at it.
Oh, for sure. And it's funny that you say like, oh, the money went straight in my pocket. Similar experience with this other gentleman that we were dealing with in our brokerage. This guy was looking to sell his a self-storage facility. When he gave us his P&L and everything else, he's like, oh, well, the NOIs or the net operating income is actually not that. I bake in my cell phone cost. I bake in like extra things. And so there's all these different things that he's baking into the expenses. So he doesn't show a lot of income, obviously for tax purposes. And it's like, okay, now we have to explain this to someone. Oh yeah, by the way,
or explain it to the bank.
Yeah.
Like, right?
Yeah,
exactly.
Yeah, that's the tricky part. It's easy for equity to say, oh yeah, okay, but then the bank is like, what are you talking about? So yeah. So
earlier you were speaking of helping raise capital. Your bird dog percents of running around making deals and stuff. And on the raising capital part, what are some of the challenges that you face with the deals? And can you elaborate on that a little more?
Yeah. Right now in this economy, it's not super hard to raise capital from equity investors. I think if you do what you guys are doing and what others do, what we do, have a podcast, put yourself out there, If you don't, a person may not have the abilities to do that, right? So to partner up with somebody who can put themselves out there and let people know about your group, et cetera. We're all built different ways. But if you're doing that, people get to know you. They have capital to invest. And so the equity side actually hasn't been too much of a problem as long as you're taking the right steps. And it hasn't been too much of a problem for quite some time. The problem is on the debt side, right? So trying to match up the deal with the debt and put that together and then find the right deals that actually make sense. Like, so we could talk about storage all day long, and then we have listeners who are like, oh my gosh, this is amazing. I want to talk to Kris a little bit more, or meet the guys at Passive Investing, which we do like dinners and all this kind of stuff for our investors and potential investors to get to know us a little bit more. They start to know, like, and trust us, and they want to give us money to go and do deals. Great. The problem is finding the deal that makes sense, right? In brokerage, you make 100 phone calls, you get, maybe 25 people who want to talk to you further about selling their deal. Maybe 10 will give you financials to underwrite it and put together a package. And then, the 5 of them will go with someone else and 5 of them will go with you, right? It's the same idea. It's the same funnel in the storage business. So it's a matter of, hey, helping equity to understand where we are. That can be a sticky problem, right? So if they have a preconceived idea that I should get 10% on every storage deal, like, that's not going to happen, right? Because deals are being bid up, cap rates are very low. Debt is somewhat easy to come by. It really depends on the deal and where it's located and all that. But, relatively speaking, interest rates are pretty low. So it's not too bad to get debt and capital. It's just a matter of setting expectations with investors and then finding the right deal that meets that criteria, if that makes sense.
Yeah, for sure. And I'm sure, like you said, it evolves over time with those setting of expectations, because I imagine 5 years ago, it's a different market. It's a different environment. Yeah. Therefore, the expectations are probably in a different situation. Whereas right now, it's a completely different market as well. So now you're constantly having to set those expectations with those individuals to make sure that you're, providing the value that they are perceiving that you are able to provide. So
that's exactly right. Like when you talk about it that way, like you go back to 2016, 17, you could find a decent deal, at a 6 cap or something like that. If you want to look at it from that perspective, a cap rate perspective, 6 cap or whatever. That same deal is a sub 6 cap today, so it's not a matter of like, I should be able to find. I remember listening to some guys talk about mobile home parks, and you buy them at a 10 cap and improve them and all that. And it's like, you're not buying them at 10 caps anymore. The information is out there. Podcasting, what we're doing, right now, YouTube videos, Instagram, TikTok, whatever, has gotten information out there into the hands of people. And so the more and more people hear about different ways you can invest in real estate, storage, multifamily, mobile home parks, whatever, the more people jump into it, and that decreases returns over time. It's basic like economics. So if people are like, I'm going to go find a killer deal during this recession, well, good luck. You'll probably find it out like in the middle of the mountains, somewhere where nobody is and all that kind of stuff. If that's what you're looking for, if you're trying to buy something in like a Charlotte, Austin, Texas, Jacksonville, Florida, Denver, Colorado, like you have to have proper expectations that meet the market. You're looking at something at a decent deal, 40,000 square feet, that's in a decent location, $50,000 in average household or median household income, growing population. That's going to be a 5 cap or less. Like it just is, and if investors aren't ready for that, then, that could be a tough time also to kind of raise capital. So anyway.
Oh, for sure. No, I think that's some great advice. So once you get to a deal, let's say you're filtering through deals and you find a unique opportunity and you put the property under contract. What are some of the due diligence items that you go through? And we kind of touched on this earlier, but if you could elaborate a little bit on the actual process of analyzing whether or not this opportunity is worth closing.
I was going to say nothing, but I was going to be making a joke. No contingency, close in 15 days. No, we'll do the typical, like doesn't vary too much from like, let's say a multifamily deal. You would do your phase 1 environmental. If people don't know what that is, it's basically like, hey, go ahead and check the soils and all that. Make sure there's no contamination in the past, underground storage tanks, that kind of thing. Kind of get out of jail free card that, removes my liability as the owner. So a phase 1, you get a property inspection, PCA, property condition assessment, and like, roofs and doors and whatnot. Doesn't vary too much there. Obviously title work, all those basic things. Check the zoning, make sure it conforms. If it's non-conforming, is it grandfathered in? Can we get a variance if we need to build more? All that kind of stuff. You want to check leases. Same idea of multifamily. You go through the lease, do the lease audit, make sure that these people actually have signed a piece of paper, that they owe a certain amount of rent every month. When did it start, et cetera. So that kind of stuff. And then in storage, I guess you want to look at, if you're going to develop, if it's full, occupied, like that's kind of straight up the fairway, right? It's not too complicated of a deal. You get a survey done, make sure there's no encroachments, make sure you're not in any sort of like undiscovered easements or whatever. We're looking at a deal one time in Cary, North Carolina. The guy's trying to sell it, wanted $6 million for it. No problem there. The problem was there was an easement to a utility company to access, I forgot what it was on his no, it wasn't a utility. I'm sorry. It was a cell phone tower deal on his property. And he built a building right over that easement. So they can come in and tear the whole thing up. Yeah, it's like, well, you got to get that fixed, bro, before we actually buy anything. So why are we going through all this? And you didn't tell us that in the very beginning. So those kinds of things can pop up at any point in time. But I think the big thing is if you're going to develop something right now, at this point in time in 2021, steel prices are just going nuts right now. Nobody knows what's going to happen. On that deal we just closed, we're going to add a 22,000 square foot building onto it. We got hit with a steel increase basically of 25%. We had contingency to cover that, but if we get hit with another 25% price increase, we probably will likely not build the building because it just doesn't make financial sense at this point in time. So that's the kind of thing, like development deals aren't as exciting right now. I was looking at a deal in Texas actually earlier this morning, and it's got about, I think, roughly 2 acres to develop on. You can build 22,000 square feet. They had the plans and just a couple steps away from permits. And I'm like, I'm not that interested in it right now because we can't pay what he wants and not develop for a year, to figure out what's going to happen with steel prices. So we just can't do it. So, if you're going to do development right now at this point in time, I would just double check that and kind of maybe pump the brakes just a little bit, depending on the cost of the land, et cetera. So otherwise, it kind of is very similar to other types of asset classes with a few little nuances.
So you're just talking about building an extra 20,000, 22,000 square feet. Have you ever been involved in another ground up construction, or is this your first one with self-storage? Or
usually we'll buy them where I was involved in one in Myrtle Beach. It was 100,000 square feet ground up, but that is a different beast. This is a 22,000 by level. Okay. And yeah, so it's like you can access on either side of the ground, like it's bi level. So each entry point is basically on the first floor, quote unquote. Yeah. So that's a much different product. And then usually when we bought them in the past from mom and pops, they're always, I call them landlocked, where you can't develop or build anymore. Maybe you could do a little bit more parking or add in a couple of portables, but usually those smaller deals are fairly landlocked for the most part.
What are some of the things that you should consider if you're acquiring like the development opportunity? I know you said material pricing, but is there anything else that?
Oh yeah. Obviously, you get a survey done with the topography to make sure, hey, how does the land sit? Is it flat? Does it slope a certain way? Where does water go? All that kind of stuff to consider. And then easements, you want to check that, setbacks, zoning. And then one thing that people don't realize is that if you have an acre of land, the whole acre is not usable for storage because you have drive aisles, you have the gate, you need to have access. Usually it's about, let's call it, rule of thumb is roughly 30 to 35% of the land is usable for actual like buildings, storage buildings. The rest is drive aisles, setbacks, et cetera. So we don't want to overestimate what you can put on the land. If you look at just go to Google Maps and Google self-storage, where you're located, zoom in a little bit to your town or city, type self-storage in, it'll pop up some facilities, find like the extra spaces, the big 3-story ones, and zoom into their parcels, and Google Maps will show you the boundaries of the parcel, and then look at the building, measure both and take a percentage of the building to the land. And you'll see, okay, they only use 50% of the land because the rest is parking and, drainage pond and setbacks and all this other stuff. So that's one thing that people sometimes overestimate is how much they can actually fit on the dirt. And then that, if you're wrong, that can throw the whole thing off.
Oh, for sure. And I imagine also, obviously market analysis, right? Because if you have a ton of land and you have the potential for development, but the market can't support, an extra 100,000 square foot of space, that's got to be another factor in the analysis.
Oh, yeah.
As well.
Yes. And that's a good point that you brought up there. One of the things is, and I want to forget what I'm going to talk about here, but square feet per person. So that's a metric that floats around out there because the National Self-Storage Association has put information out there saying, hey, we have depending on which source you talk to, anywhere from 6 to 7. I've seen 8, but right around 7 square feet per person in the United States, which is an interesting number. That's all that it is, though. So if I have a piece of land and I'm like, okay, I want to put storage on it, and I get something called a feasibility study done, the bank will usually require this feasibility study. And that's where you hire a third-party person to come in and tell you if this is a good idea, a bad idea, or a so-so idea. And they'll do a whole like comp study and market demand study. They'll visit, depending on what you pay for, what level of study you pay for, and what the bank wants. They will tell you square feet per person, and they'll do a pro forma for you and all that stuff. So it's actually a very comprehensive thing that they do, and it costs a couple $1,000s, several $1,000s to get it done. But they'll give you the study, and it might say, hey, there's 7 feet per person in this market. Potential demand is for another, maybe 20 or 30,000 square feet. They would use the statistic I mentioned earlier, square feet per person, that nationally it's 7. So your market might be at or near equilibrium. The 7 number, the square feet per person in the market, is an interesting number, but that's all it is. What really matters are the rates that your comps are charging and the occupancy at those comps. This deal I'm looking at right now, actually today, it is about 20, by the time there's another development just completed, I think it's around, let's call it 25 square feet per person in this market. Anybody looking at that, 25 to 7 is a completely different number, right? So you're like looking at like, this is the pass, I'm not going to even mess with it. But I called all the comps, and guess what? They either stink because they don't answer the phone, or they're all full. So the demand in that market is drastically different than what you would think from the 7 feet per person. If the 7 feet per person was true across the board in every city, county in the United States, there should be a high vacancy at all the comps at these facilities, right? But there's not. They're all full. Literally calling, well, I only got one, 12 by 40 left, and that's it. I only got 7 10 by 10s, and that's all I got. I got 7 units available. So I'm giving a little accent there because it was in a southern state. But the point is, and then some of them don't answer the phone either. So the point is you don't want to just look at that and then stop and say, oh my gosh, this is oversupplied, move on to the next one, or it's undersupplied. You actually want to take the time to call the facilities and see, hey, do you have anything available? What's trying to derive the occupancy somehow from the managers there. So that's super important. So yeah, the bank's going to want a feasibility study done. You should be willing to pay for one, because if you're going to spend $1 million building something, $1 million plus, then you should spend $5,000 finding out if it's a good or bad idea, right? But at the same time, don't let it stop you. Find out the occupancy at the competing facilities and see, are they full? If they are, there's probably unmet demand in that market, because people just have a different lifestyle there, or they have a lot of stuff, or there's a lot of businesses, or whatever the story is. So yeah.
Yeah. And like you said, I mean, I guarantee you that the per square foot amount here in Louisville in certain submarkets is going to be different than the per square foot storage capacity in your market and the different submarkets within your market, right?
Oh,
so
yeah.
Putting in that legwork, especially in that when you're analyzing those opportunities, will put you ahead of the competition, because surprisingly, a lot of people don't do that. They just kind of take things at face value and they're like, okay, well, this doesn't seem to be a unique opportunity. But you're right. I think taking that extra step and really just pushing forward and try to uncover more information about the market is crucial.
Yeah, that's
awesome.
Exactly right. Yep.
Yeah. So one thing I wanted to ask you, and this is something that we've referenced throughout this episode, is leveraging social media. I know you are heavily involved, obviously, with podcasting. You have your YouTube channel. I've seen several of your videos. Great job, by the way. They're awesome. I'd highly encourage you guys to check it out if you guys haven't had a chance to check out his YouTube channel. We'll include in the description. But can you kind of talk a little bit about, how you've been able to leverage social media to grow your brand, right? PassiveInvesting.com.
Yeah, that's super important. So I like Dan Hanford, the way he puts it. So he's the founder, one of the partners at PassiveInvesting.com. He has I forgot what it's called. Like, it's like a triangle basically. And it's the words know, like, and trust. And at the top is know, then like, and then trust. You draw a little triangle, put know at the top. Most people think, when somebody knows, likes, and trusts you, they'll do business with you. But which of those things is first? Know, like, or trust? Most people say trust, and trust is super critical and important. It's know, right? So if I don't know you, I'm not going to take the time to trust you. I mean, it's kind of a no-brainer. I don't need to explain that. If I don't know you, we're not doing business together. So I got to get to know you first. And the way we do that usually nowadays is through social media. So you put your posts out there, your videos, podcasts, whatever it is. It's an incredible tool. Gary Vaynerchuk talks about that. Like, it's removed the middleman. Back in the day, you know, when I was a kid growing up, like if you want to be on TV, you got to find an agent and do all this other stuff, right, to get famous, or music or whatever it is. Now you don't need to do that. I just saw an article the other day. They're talking about what is it, Gen Z kids, which are my kids also, but you know, putting out their music, no labels, just putting it out there on TikTok. I forgot what her name is now, her stage name, but she put out some romance song or what, I don't know, whatever. She got famous, and now somebody's producing it for her, blah blah blah, and she's going to put out an album. There's no agent involved. There's no like, go to Sony Records or, you know, whatever it is and go get, you know, go in the studio. Why? Like, we have great mics. We have the ability. I have a camera here, you know, like follow our cell phones, you know, it can obviously record whatever it is we're doing in nice high def video live, etc. So I think people who aren't leveraging it, if somebody still thinks it's a fad, I don't know, like, okay, you know, I don't need to convince anybody that it's not. That's a weird, you know, that would be a weird form of thought. So if anybody's questioning it or whatever, stop questioning it. Just do it. Pick up the camera, start talking. If you're not good at talking, like Gary Vaynerchuk talks about, start writing. If you're not good at writing, find someone who is, you know, and can help you put your thoughts on paper or out there for the world. If you need to partner with somebody who is good at, you know, doing this kind of stuff, and you're trying to raise capital or do whatever, then absolutely, like, take advantage of it, because it's not going to go away. It's not going to diminish over time. There'll be another one. TikTok is the latest. Clubhouse is the latest. If you don't know what that is, go check it out. But Clubhouse, and then something else will come out. And in a sense, it's like it's usually like a replay or a repeat of something else, just with a little twist to it, usually, right? It's not like something like, oh my gosh, this is, you know, I never heard of this. It's kind of like something else, but it's got a twist to it, and it kind of makes sense, and the people jump on. So it's not going to go away. There'll be something else that comes up after Clubhouse. You know, the YouTubes of the world is not going to go away. But people should definitely take advantage of it. And it's helped us tremendously. Like this little deal that we did over in Charlotte, we closed on March 1st. We needed to raise, I forgot the numbers exactly, but at $1.5 million in equity, something like that. We had that raised in 24 hours. Within a week, we were oversubscribed. We had $8 million of equity committed. So we had to tell a lot of people no. Right. So they're like, go find another deal because we need to place some capital. So you can do a lot with $8 million. You can buy a lot of facilities with that. So that's why we're desperately looking. And I don't say like we are desperately looking for another deal. We're looking and underwriting and putting numbers together. So, but the reason we can do it is because of social media and people getting to know us.
Yeah, 1000%. I keep telling people that all the time. It's where, you know, I think the biggest hurdle for a lot of people, in particular when you're talking about some video content, is that they feel like, oh, you know, I looked at weird, or, you know, they're self-conscious about the fact of putting themselves out there. But what I always tell people is like, you're going to suck the first time you do anything. It doesn't matter.
Oh, yeah.
I mean, I can imagine when you first started doing some things, it probably was awkward and uncomfortable.
Super.
But over time, you get better and better and better. And the key thing that you just said is people need to know you. Because if they don't know you, why would I give you my money to invest if I don't know who you are?
Yeah.
You know, you could be the smartest person in the world. You could have gotten a Harvard MBA. You could be the most credentialed person ever. But if I don't know who you are, what does it matter? You know, it's a different story. And obviously there's going to be people who don't like you, and that's fine. They'll filter themselves out. But there's going to be a subsect of those individuals that really know, like, and trust you. And at that point, you know, that's where the magic happens. So
that's right, man. JLD, John Lee Dumas, he says your vibe will find your tribe. You know, so whoever you are, that's who you will appeal to. And the other people, like, it doesn't matter. They'll go find somebody else. We're not supposed to appeal to everybody out there. They can find someone. There's enough options where they can find somebody that they gravitate towards. So yeah, man, when I first started, it was so awkward. First, it actually took me about a year to get over the idea of, or to get like the idea of like doing it and actually doing it. It's really hard when you start. Like, you don't know what mic to get. So you watch all the mic review videos. Oh, which one should I get? How much does it cost? And all this kind of stuff. And really, you could just buy. I had a Yeti mic that's over there now. It's $100 whatever it is. I just use this $20 one. So it doesn't, like, what does it matter? It doesn't matter. You know, this webcam here that I'm using is like $50. It probably is actually 3 years old now. They don't make it anymore. So it doesn't matter when you start or how you start. It just matters that you do start. And it will be weird. It's the first iteration. I got my wife's cousin. He started a drone company he does out of Virginia Beach, but he goes to New York and does a lot of stuff. He does stuff for movies and commercials. He started from like scratch, and he's redoing his logo. His other logo wasn't that great. He just got it done on Fiverr or whatever, but he's been going at it for 4 years now. So he's got it redone, you know, like Who cares? The first iteration. That's a part in my mind too. Like I can underwrite and do Excel and all that kind of stuff. No problem there. But when I try to build a model from scratch, like I have a hard time doing that because I want to make it perfect from the beginning. And it's better for me to say, hey, can somebody build this for me? And then I'll just use whatever. Because I've seen all kinds, right? Good models, bad models, etc. But when it's mine, like I want it to be perfect. That's my problem. I let that be kind of the reason I procrastinate on things, just to be honest with the audience here. So, but you can't do that. Got to overcome that. The first one's always going to be ugly, and then just iterate and go from there.
Completely agree.
Yeah. I've seen some ugly models, including my own. So yeah, it's just something like a stumbling block in my head. It took me literally a year, guys. I like ordered the stuff. I ordered my mic and the boom stand and all that kind of stuff, and then sent it all back to Amazon. And didn't do anything for a while. And I was like, forget, I got to do something. So that's pretty much how I started. And by doing it, opened doors. But that fits my personality. That's not everybody. My partner on the self-storage side, John, like he built our model. He loves building the models and doing all the stuff in Excel. He can talk just as fine, just like everybody else. But whenever we meet somebody, I'm like, hey, I'm the mouth and he's the brain. It's like I'm just talking 100 miles a minute, and that's what I'm good at. And he's good with the numbers. He's a CPA, et cetera. So that's kind of how we flow together. And I like that, and he likes it too. So it just makes a lot of sense. So if you're not good at it, go find someone and partner with them.
Absolutely. So I'm going to kind of redirect us here. And we're going to still stick with the self-storage industry. And what do you see how it's going to evolve in, say, 5, 10, even up to 20 years, a couple of decades from now?
Yeah. Well, let's go ahead and stretch a little bit. So 5 years, I think that the Bluetooth technology that they have out there for the locking and overlocking and all that will probably will hopefully improve and get a lot better and a lot more simple. I think the locks so let me back up for a quick second. People who don't know, in the industry in self-storage, when someone doesn't pay, they go late, you do what's called overlocking them. So usually on the little latch there, they have 2 holes, one for the customer's lock and then one for the manager, the owner's lock. So you overlock that person so they can't get into their unit until they pay. That's the most labor intensive part of managing, because you got to go around and see who's late and then overlock everybody. And then once they pay, you got to go out there and take your lock off so they can access their stuff again. Well, when a customer pays, they want access right away. So whatever you're doing, you got to go back out there, go back out there, unlock, take it off, and let them have access to their unit again. So they have Bluetooth locks now that will actually do the automatic locking, overlocking, right? It won't let the customer access the unit any longer. Once they pay online, boom, they have instant access back to their unit. Those cost roughly right now about $240, give or take, per lock, which is pretty stinking expensive, right? When I was with the company in Raleigh, we developed something called the Da Vinci lock. So Brad Minsley at 10 Federal, that's where I was working. I remember it was an interesting story, but he had the idea and the concept, put it all together. And it's really a simple system. The lock itself has a serial code etched on it. The customer pays, they just text back that code to the brain, the cloud or whatever, and the cloud texts back the combo. So they can take the lock off themselves. So stuff like that type of technology that makes things easier for everybody is going to evolve and grow, I think. I don't think self-storage as a whole will go away. I think that technology will become cheaper, more prevalent. We'll see it in more and more facilities. When you go visit a nice Class A 3-story deal, it'll be full of Bluetooth locks, and people will just be used to that kind of technology, right? Because it'll become cheaper, easier to use. But I don't think the Clutters of the world. So one thing, there's like when I say clutter, the company Clutter. So there's Clutter, there's Neighbor, there's a few others out there that are trying to quote unquote disrupt the industry. And I think it's really funny because that's fine. Like they have a business model where if you want to store something, they come to your house, they pick it up, they give you bins, you pack it up. If you have a big awkward object, they can just take that as is. They'll drive it out to a facility somewhere or a warehouse, store your stuff, take pictures. You can access it from your phone. You say, oh, I need this bin, but it has this thing in it. You click that, they bring it to you within, I think, 24 or 48 hours, something like that. So you don't ever have to visit the facility. And that's great. Some people will pay for that convenience in major metropolitans where it makes a lot of sense. I don't think they're going to disrupt anything though, because the cost of storing stuff is going to be much higher in New York City, for example, or San Francisco, or these some gateway markets, right? Than it would be in a Charlotte or Nashville or Knoxville, Tennessee, or something like that. This wouldn't make sense. On top of that, the current owners can just start their own system. of doing that and compete with clutters. So I went to visit an owner who actually owns a facility not far from where I am, literally like 5 miles away, because I want to buy his place. And we were just talking and whatever. And I looked and saw the bins by the door, and they're nice, like hardcore plastic bins. And I asked him, what do you got going on over here? What is this? And he said, oh, I'm just trying to experiment a little bit. I see the clutters and all that, trying to do some stuff. So I think I might do the same thing. I own a facility. So why don't I go ahead and get a truck and get the manager to drive the truck over and pick up the stuff and bring it back to my own facility? So some owners aren't dumb. They'll just copy the model and just do it themselves. So I don't think they're going to disrupt anything, but I think they're going to exist and they'll be out there. And it's funny, Clutter, I think it was last year or the year before, they actually ended up buying, I think it was 3 or 4 self-storage facilities themselves in their market. And they spun it as if, oh, we're going to just I don't know what they said, but the point is, hey, we realize it's actually a good idea to own self-storage facilities versus leasing from a warehouse. So I don't think they're going to disrupt anything. If you go even further than that, we aren't going to change our habits, barring World War III or a total transition to complete and utter socialism where nobody owns anything, right? So literally, storage isn't going to go away. It's really hard to change consumer behavior. And we just like to buy stuff and have stuff and need to store stuff. And it's not always a hoarding thing. I remember talking to one guy and he was like, oh, I don't like your business because it's nothing about materialism and, people having too much stuff and not knowing what to do with it. And that's true. But that just because you have a messy bed doesn't mean it's a bad thing, right? Some people make their beds and some people don't. Some people hold on to stuff and some people don't. We're just trying to provide a service for people who need it and businesses who need it and hospitals who need to store stuff and attorneys' offices and whatever else that need to store documents, et cetera. So it provides a service. If the service wasn't valuable, nobody would use it and the market would speak in a sense and facilities would shut down. But the point is the market needs it. The industry is not going to go away. It's not going to be disrupted by the clutters of the world. They'll coexist. And I think some technology will become cheaper and easier. We'll see facilities where you can just access from your phone or whatever it is, whatever device is 20 years out in the future. You won't need a manager on site. Most managers sit around and some work very hard, but a lot at mom and pops will sit around and watch Netflix all day. So you don't need a manager in some of those mom and pop owned facilities. Sorry, young managers who are listening to this. I know some of you guys work really hard at extra space and public storage, and then there's others who don't. So I think the technology will grow and grow where you don't need a manager on site. And the owners and asset managers, et cetera, can run their facility and their portfolio without anyone there. So
that's interesting. Yeah. Another thing that I'm kind of interested in, I don't know if it's something that's feasible or not, but I see a lot of logistics companies utilizing cubic feet more so in their warehouse space. So I'm curious to know if, like, for example, the clutter concept where you have the bins, if you could buy these big warehouses that are just open space warehouses and then have like pallets where you can stack these materials 30 feet, 40 feet in the air, and you utilize the cubic footage of the space, thereby lowering, the cost of occupying that space. It's kind of interesting. I don't know if that's something that's
So that's what Clutter does. There's others too, Make Space, I think, and a few others that's what they do, is that they utilize cubic footage, right? And so the owner who I was talking to, he said the exact same thing. He said one of my units rents for, whatever the number was, $125 a unit. And that's for all the square footage there. But if I can get people utilizing bins and charge them $50 a bin or whatever and store them in that unit, then obviously I'm, quadrupling my money on the same unit. So absolutely, there's nothing wrong with that. And I think if some owners figure it out, then other owners will do the same thing. And that information will spread and other owners will obviously adapt. That's why I don't think clutter is going to disrupt anything. Like those types of companies, they're talking about disruption. And I think that there's a commercial on TV now, or I don't watch TV, but on like YouTube TV, that I keep seeing, like self-storage sucks, I think is their tagline or something like that. We'll come pick it up and all that. Go for it. Absolutely. Like, if that's what your thing is, then go for it.
Well, yeah, So if you were to give yourself advice, so let's say you talk to Kris at, right when you're about to get into this whole journey, what are some of the things that you would tell him about the coming journey that you wish you would have known when you first started out?
That it's harder than you expect. You'll look at 100 deals. You need to know how to build a lead funnel. So to look at 100 deals to find one that makes sense is probably the ratio. Maybe 1, 2, or 3 that makes sense. So 1, 2, or 3% closing rate. That not every deal that you look at is going to work. So don't get so excited about it. Don't worry about cap rates so much, right? Don't worry about all the other things that people talk about, like square feet per person and going in cap rates and all that stuff. That's a cap rate is, if you don't know, NOI divided by the purchase price of the property. It's a flashpoint, and it's just one period in time. It's backwards looking. It's not forward looking. Don't be afraid to take risk. When you buy a facility or any property for that matter, you're taking the risk. You can't de-risk the deal, right? It's there's market risk, there's lease up risk, there's all kinds of risks. If you're trying to buy on the history of it, then you're not taking any risk and you won't do any deals, period. Right? That's the wrong way to look at it. And I know that people are like, oh, well, yeah, you got to be conservative. Yes, like don't put in 10% rental rate increases every year. You know, that's how you be conservative. You put in 3%, 4%, 2%, whatever it is you want to do to be conservative. But in buying property or investing in anything, you're taking risks because the future is uncertain, right? And so you can't be looking in the past and base your expectations and your purchase price on that. You'll never get any deals done. I think also start earlier with the social media stuff. I would have done that a lot earlier, like 2 years earlier, 3 years earlier if I could have. I wouldn't have delayed on that because it's super, super important, especially to raise equity. I would get my capital straight first. Don't go find a deal first. Get your capital lined up first, your equity and your debt. On the equity side, obviously doing what we already talked about, putting yourself out there and getting people help them understand the market and where we're at and all that kind of stuff. So that when you do have a deal that makes sense and you present it to them, they're already kind of teed up, right? But with the bank side of things, talk to banks right away, or lenders right away, or whomever, brokers right away, mortgage brokers right away, debt brokers, so that you have that side of things lined up as well. And if you can't qualify for a loan, find people who can. That's what I would do. I would do things that way versus what I did years ago. That's what I would have done to prepare myself for the future. Yeah.
Oh, sure. I run a few meetups, and one of the meetups we had, actually, Hunter Thompson, who talks about raising capital. And one of the things he said that he wished he would have done a little bit more when he first started was not look at the cap rates so much. I mean, obviously it's important, but what he said was that, if you have $100,000 operational inefficiency in a 5 cap, the appreciation that you could achieve by executing that operation plan is so much higher than you can in a 7 cap or an 8 cap, because every dollar that you put towards the NOI in a 5 cap is going to give you $20 in return versus a 7 cap or an 8 cap. So it's kind of interesting to hear him say that.
Absolutely. I agree 100%. I don't worry about the cap rates, the current cap rate on the deal, going cap rate. It's important to understand and know and answer any questions about it. But yeah, I wouldn't worry about that. And I would look in good markets too. I wouldn't look in where we were looking before, like tertiary markets and kind of the out of the way places. That's just me, right? I want to own in a market that's growing, that people want to live there, and that the future is a little bit more certain versus something like that, versus something that's more rural or more out there. Now that's just me. But if I lived in an area that's kind of how it was, and I knew the area very well, then that might be a little bit of a different story, right? So, but for me, it's just a matter of, hey, I would buy in like downtown Charlotte or a growing urban area of Atlanta or something like that, which is what we're looking at now. So, yeah.
That's great. So earlier you spoke of the Self-Storage Almanac, the book, the publication. What I'd like to also ask people is, what is a most impactful book, and it doesn't necessarily have to be on self-storage or even investing, that for you yourself have actually read, and what's something that's changed you for?
I'll give you 2. Number 1, the Bible. I think that Book of Proverbs has a ton of information and advice on how to live, how to treat others, how to conduct business, how not to be lazy, how to be diligent. There's a funny proverb. I can't remember exactly how it goes, but basically says, like, the sluggard says, there's a lion outside, I'm going to be murdered in the streets. And when you read that, it's like, I don't understand. What do you mean by that? I was thinking about it the other day, and it's like, oh, the sluggard makes up whacked out excuses for why they won't do stuff. Like, that doesn't make any sense. Like, you're going to just say, oh, let's say I can't do that because of this, or I can't do that because of that. So it's actually just laziness. It's procrastination. So stuff like that. But then another good book I'm actually reading, let me pick it up right here. There's a couple more I wish I could mention, but I was an econ major at school, and it's been a little while since I went, I was in school, but it was a fantastic learning experience. And so my wife actually bought this, Basic Economics, Thomas Sowell. And if you don't know, I'm on the podcast, I'm holding the book up here. So, but Basic Economics by Thomas Sowell, fantastic book. I've been listening to it on audio. So I'm in chapter 15 now, and then read it every so often at nighttime, but fantastic book. And I think it's good to get outside of our focus sometimes, right? So yeah, I could read stuff on storage all day long. I get kind of tired of it because you kind of already know certain things, right? So it's good to hear someone else's input on just markets and risk and all kinds of other things that are very interesting. So, and if you, I challenge people too. We're kind of like the society that we're in right now. It kind of worries me a little bit, right? It's okay to have public discourse and disagreement. That's where we're all going to disagree on something, right? But I think right now we see so much talk about socialism and how capitalism is bad and just the news media, et cetera. I can't stand any of it at all. And for a good reason, I think, because we live in a society, in this podcast and real estate in general, if you are a socialist, get out of real estate. Real estate is the private ownership of private property. Socialism is the opposite of that, right? So anyway, it's just, I think guys like Thomas Sowell and others like him, we're losing and missing a piece of the advice that they had. And anybody who likes it, maybe myself, maybe there's a listener that automatically hates me now because I just mentioned somebody who's a big proponent of capitalism. I think we're losing some of the perspective, and it's becoming really unhealthy to have healthy debate, right? So now if somebody's like doesn't agree with you and they're a hater or they're this or they're that, or whatever it is. So anyway, I love Thomas Sowell and obviously the Bible. And those two things aren't always synonymous, of course, but I do think that we're in a place in our country right now where both are greatly needed.
Sure. And again, I think mediums like this, where we can just discuss ideas, whether or not we agree all the time, I think that's a very valuable piece of advice. Because again, this country was founded and is going forward with countervailing ideas. There's always going to be people on the other side of the spectrum that may or may not agree with you. But in order for us to continue moving forward and prosper, we need people to be able to have open discussion. We need to have people talk about differing ideas. And it doesn't matter if you just don't necessarily agree with what I have to say or what you have to say or what everyone else has to say. But I think it's important for us to sit down, at least have that discussion, and not automatically just say, oh, no, I don't agree with what you're saying. And that's it. I have no reason to be able to process the information or your argument.
That's exactly right, man. Yeah, you have to be able to listen to the other side, right? So I mentioned the Bible. Somebody's a Muslim. They don't think the Bible's anything. Fine. Like, that's no problem. That's not going to hurt my feelings, right? Yeah. We can have a lengthy discussion on it and just talk about it and still be friends. Like, that's the best thing in the world, right? Like, somebody's a socialist or they quasi-socialist and they don't, see it the same way I do, and they see some issues with capitalism. Fine. Like, let's have a coffee and talk about it or whatever. That's not a big deal at all. But if you watch the media and all that, it doesn't, even on both sides, Fox News, Drudge Report, CNN, MSNBC, both sides, it's clickbait, right? So the article is so-and-so killed such and such. Oh my gosh, these guys are jerks. Let's click this thing and look at it. Biden sucks. Oh yeah, he does. Let's click this and look at it. And it just kind of feeds into our confirmation bias and our preconceived ideas of the way things are sometimes. And it happens on both sides, right? So we're kind of off into a different discussion right now, but still, I think it's really important to have proper perspective, like you said, and for us to be able to get along in this country and be thankful for what we have. I'm very thankful. I'm half Korean. My mom is from South Korea. My wife's from, she's half Puerto Rican, actually. So we have a little bit of a mixed family here. Yeah, we have a mixed family here going on. I'm super thankful to live here in the United States of America. I don't want to live anywhere else. And I think we're very fortunate to live here, that we can actually have these kinds of debates and arguments and we don't even realize it. I'm very thankful for this country. My mom came here without speaking any English, and built a nice life for us as a family in California. I see a lot, I'm half Asian, and all the stuff like the Asian stuff, I went to Carolina. I see some students complaining that they're Asian. They're the only Asians in the class. Guys and gals, I went to Carolina in my 30s as an undergrad. I didn't go get my MBA. I had a kid, and then we had our second child there at the hospital on campus while I was in school. In every single class, I was the odd person, because can you imagine sitting there in class with like a bunch of 20-year-olds and you're like 30 with wife and kids? Like, you stick out like, what, who's this old guy in the class? And that's kind of how I felt. I didn't complain about it. I didn't say I'm not visible. I'm invisible. I have opportunity here in front of me. I have opportunity. Let's make the most of it. Let's make the best of it. Let's work our tails off and have it pay off for ourselves versus complaining about stuff. And people aren't going to like what I'm saying. I get it. And we're off the path here of self-storage, but I just think it's really important to have perspective, whether or not we agree on everything.
So just to kind of round out the podcast episode, by the way, I think we've talked about a lot of different topics, and it's been really, really insightful for everyone. I just wanted to touch on one thing, and that's what's known as Commercial Real Estate Treasure Chest, which is a repository of resources that we offer to all our listeners they can access all these different types of resources, whether that's helpful PDFs, spreadsheets, whatever else. So what are you willing to contribute today for the CRE Treasure Chest?
Absolutely. I have a little article called The Pros and Cons of Self-Storage Investing. And so I run through obviously the good of it and I wouldn't say bad, but just like some of the drawbacks that people don't think about. And I don't want anybody to misunderstand what I've said on this podcast. Self-storage is not the greatest thing since sliced bread. The best thing for anybody to invest in or participate in is the thing that they understand, right? And so as long as they have a full understanding of what they're doing, then go for it. And so I think the article will help people have a balanced approach to it. You know, I have nothing to sell. I don't like have a guru coaching course. I don't think there's anything wrong with that. I just don't have anything like that. And I don't want to. I just want to provide the information in a balanced manner. So yeah, happy to contribute that.
Thanks so much, Kris. That's awesome.
Yeah.
And so all this information that you said on the podcast, and I know people are going to want to contact with you, and in what way can they reach out to you to ask questions about more self-storage or possibly getting involved with you and maybe investing or...
Yeah, or talk about capitalism. No, I'm just kidding. So they can reach out to me. They can reach out to me at on LinkedIn. I'm there. On Facebook, I'm there. Kris, Kris, Kris at passiveinvesting.com. If I take a little bit of time to get back to you, it's just because I'm super focused on trying to find deals. So I usually kind of put those messages off to the end of the week or something like that. So be a little patient. But if you want to tune in, we have a weekly webinar where we talk about some aspect of self-storage investing. Just visit storageinvestornation.com. And self-storage is so many S's, and I always forget what is what. Storageinvestornation.com. Storageinvestornation.com. We also just launched our podcast. If you go to storageinvestornation.com, it will link you as well. There's a link there. You can go to the podcast and download that wherever you listen to your podcasts. We also have in October coming up the Storage Investor Nation Summit. We just had the summit 2 weeks ago. I think it was April 15th, 16th, and 17th. So the next one is October 7th, 8th, and 9th. On this last one, we had about 400 attendees. So we expect that and hopefully a little bit more on the next one. We had, I forgot how many speakers, like 30 plus speakers, and it's all online. So you can tune in anywhere. If you do the VIP package, you can kind of talk to people in the VIP room on video, just like we're doing right now, ask a bunch of questions, and some of the presenters will be there and all that stuff. So I'll be there. You can always talk to us that way as well. Ask us questions that way as well. So storageinvestornation.com will get you all the links to everything I just mentioned.
Awesome. Yeah. And we will include that in the description. So if you're listening to this podcast episode on Apple Podcasts or wherever podcasts are available, that'll be in the description. If you're watching this on YouTube, we'll be posting all those links below as well. So Kris, thank you so much for stopping by. I know that a lot of the people that are listening to this podcast are getting a lot of value from this particular podcast. If you guys are watching on YouTube, please smash that like button and subscribe to the channel. It really helps with the YouTube algorithm, ensures more people can listen to this podcast episode. If you're listening to this on a podcast medium, whether that's Apple Podcasts, Spotify, etc., please leave a 5-star review. Again, it helps us spread the message and expand the knowledge of people in the commercial real estate space. So again, Kris, thank you so much.
We appreciate
Raphael,
it, Kris.
appreciate it. Yeah, thank you, Jeff. Appreciate it, man.
All right. We'll see you guys next time.